Welcome to the Stock Market Palantir. Today we are going to talk about TSLA. It is, I think, undeniably the most fascinating stock in modern equity markets right now. It's a true battleground where, fundamental and technical forces just collide.
Absolutely.
And as of early December 2025, we've witnessed just an absolutely sharp, rapid, bullish move. The stock's trading near $454.53, and it's aggressively approaching its 52-week and all-time high of 488.10. We're talking about an approximately 18% surge in a single week.
And that surge is precisely what we need to unpack. I mean, we both see the speed, the magnitude, but we have to immediately bring in the highly complex market microstructure at play here. The materials shows that dark pool trading, it accounts for a majority of daily volume, often 60% or more.
Right.
So that means the visible price discovery, the price you see ticking on the screen, that's being determined by a minority of the actual liquidity. So the core question for us is this: does this recent surge reflect a sustainable, fundamental valuation reset based on its AI and robotics optionality, or is it a transient, structurally engineered volatility event driven by market mechanics and frankly, highly speculative sentiment?
I see why you emphasize the mechanics. I do. But I would argue strongly that this is a justifiable and, honestly, potentially long overdue fundamental valuation reset. I'm staking my position on the belief that the market is finally, and rationally, treating TSLA as a nascent AI monopoly, not just another automaker.
And I'll be taking the other side. I'll maintain that this rapid price action is primarily driven by fragile structural dynamics and speculative retail positioning. It's a move that has, I think, temporarily detached the stock price from the immediate quantifiable realities of the business.
Okay, so let me just outline the case for the fundamental reset. The primary catalyst here, it goes way beyond quarterly vehicle deliveries. It is the confirmation of the Austin robotaxi fleet expansion, which is expected to double in capacity by the end of this month, December 2025. Now, while the number of vehicles is still small, the market correctly interprets this as a signal that key operational and regulatory bottlenecks are being resolved. Pivot shifts the entire valuation calculus toward a high-margin software-as-a-service or a SaaS model. The market is pricing the probability of that robo-taxi destiny. And, structurally, the company shows robust capital health. People overlook this when they talk about volatility. We have two historical forward stock splits, 5-for-1 in 2020, 3-for-1 in 2022. That signals continuous capital appreciation. It fundamentally separates TSLA from competitors who sometimes have to do reverse splits, which is, as we know, typically a tool of distress.
Well, that's an interesting historical point about the splits, and it does reflect past strength, I'll give you that. But I would frame the current structural situation as inherently fragile. While the past was healthy, this recent 18% move is, I think, mathematically explainable by aggressive market microstructure dynamics and speculative excess. We can quantify that risk. On the key rally days, let's take December 3rd, the off-exchange short volume ratio spiked to nearly 65%. This ratio is critical because it indicates that market makers are internalizing massive retail buy orders. And to facilitate that demand, they are temporarily shorting the stock themselves, creating a huge short inventory that they must cover later.
And what's the mechanism pushing this retail buying that forces that dynamic?
It's high-risk speculation driven by narrative. This intense retail buying is fueled by the catch-up trade narrative you see on large trading forums. And that enthusiasm is expressed primarily through, aggressive buying of YOLO out-of-the-money call options. They're targeting these aspirational strikes like $460, $470, $500. This volume of leveraged calls triggers what's known as a self-reinforcing gamma squeeze. To manage their risk from selling these calls, market makers are mathematically forced to buy actual shares on the lit market, which accelerates the move, totally independent of any new fundamental news.
So it's a feedback loop, essentially.
Exactly. It's structural, not organic. And the consequence of this frenzy is staggering.
a current price-to-earnings ratio sitting near 286. That valuation just cannot be sustained if the AI timeline slips by even a few quarters. Investors will be left holding a traditional auto company with, demonstrably declining margins.
That brings us right to our first real contention then. The weight of optionality versus this near-term reality you're describing. You focus heavily on that PE ratio, but you have to acknowledge the market is inherently forward-looking. It's capable of valuing cash flows that are years away. I mean, the total addressable market for FSD licensing for the Optimus robot program expected in late 2026 is theoretically uncapped. I contend that the market has correctly and rationally decoupled the stock's valuation from near-term auto results because the potential AI revenue just dwarfs those short-term manufacturing margins.
I'm sorry, but I just don't buy that full decoupling. Let me give you some tangible evidence that the market has not escaped the reality of margin pressure. Just look at the recent strategic pivot in Europe. The launch of the stripped-down, lower-priced, standard Model 3, priced sharply at what? 37,970 euros?
Right.
That was specifically designed to undercut competitors like the Volkswagen ID.3. Now, while some might see this as a smart defensive move, it is undeniable evidence of current margin compression and, frankly, softening organic demand for premium EVs. When a company has to resort to significant price cuts to move volume, that is a real near-term risk. How do you square that uncapped AI future with the tangible need to clear an elevated U.S. inventory of nearly 10,800 units? Optionality is a projection. Margin erosion is a measurable fact right now.
I concede that margin pressure is a measurable short-term concern, but I frame that pivot differently. To me, it's strategic agility. They're leveraging a superior cost structure to maintain market dominance. They're giving up a bit of margin now to own the market later. That's a strong, disciplined move, not a distressed one. But that takes us neatly to how we view the signaling for this run. I think the signal was primarily technical, independent of the microstructure noise you highlight.
See, I come at it from a different way. The market microstructure is the primary accelerant, and it overrides a pure technical signal when liquidity is fractured like this. We go back to that high off-exchange volume consistently above 60%. This means the publicly visible price is by definition determined by a minority of the liquidity. So when market makers have to reconcile that short inventory they created in the dark pool, they are forced to chase the price up on the lit market. That's what's exacerbating the volatility.
Okay.
But there's another piece of evidence confirming this liquidity stress: the failure to deliver spikes in November 2025. We saw acute FTDs, roughly 60,000 shares on November 3rd alone. Failure to deliver means massive demand outstripped immediate supply. That shows acute stress. This forced resolution in December suggests the rally was less about new fundamental insight and more about a mechanical necessity to cover short inventory.
That's a compelling point regarding mechanical forces. And I don't dismiss the power of a gamma ramp. I don't. But I do challenge the causality. The technical setup provided the necessary entry signal independent of that opaque dark pool flow. The stock traded in a well-defined symmetrical triangle for 4 months. The successful retest of the $385 breakout level, what we call a successful defense, that, followed by bullish algorithmic triggers like the MACD crossover, confirms institutional engagement beyond just retail noise. So even if retail forced the hedging, sophisticated capital recognized and acted on that technical entry point. Furthermore, TSLA's rally has decoupled from the mixed sentiment on other Magnificent Seven names like Meta or Google. It suggests an idiosyncratic rotation benefiting TSLA, potentially linked to that anticipation of regulatory ease for FSD, the so-called Trump trade, where investors are pricing in the possibility of accelerated deployment.
The regulatory put option is certainly a powerful force in sentiment, I'll agree, particularly for a company whose success depends on government approval. But it's still an external, non-fundamental factor. It's tied to political cycles, not core operational execution. It's just another reason why the stock's movement is more narrative-driven than valuation-anchored.
Then let's look at the sophistication of the engine driving that narrative. This is our third contention. I would argue the current retail engine is moving past pure, blind meme speculation. These traders are now executing a comparative value thesis, the catch-up trade. They justify this high beta AI play because, demonstrably, TSLA had lagged other Mag 7 stocks like NVIDIA earlier in 2025. This isn't just gambling, it's a relative valuation argument. And their focus on precise chart patterns, identifying 488 as the technical target, and their use of concepts like yield boost, selling puts to finance calls, it shows a significant tactical maturity. It's sophisticated risk-taking, not blind gambling.
I acknowledge the shift in lexicon. Traders have certainly learned to talk the talk. However, buying deep out-of-the-money calls driven by high open interest, the core of these YOLO trades, it remains a volatility bet centered on leverage. It's not a stable, fundamental investment thesis. That aggressive upside betting is based fundamentally on external factors, whether it's the regulatory put you cited or the belief in a continued gamma wrap. And the risk here is systemic. The reliance on hitting that 488 target is a psychological trigger. If the stock misses and reverses violently, this highly leveraged sentiment engine could turn against the retail buyer just as fast as it propelled the move up. The sophistication of the trade doesn't negate the fragility of the price.
That's a fair assessment of the downside risk, but the fact remains that the stock successfully decoupled from its near-term automotive reality because both institutional and retail participants are pricing in the probability of success for the robotaxi and cybercab destiny. So this price action is, I believe, fundamentally sound because the market is forward-looking, and that technical confirmation provided a validated entry signal. The stock is successfully trading on optionality.
And I maintain that the current price is dangerously dependent on the continuation of these fragile, structural mechanics, the gamma ramp, and the successful, zero-slip execution of an extremely aggressive AI timeline. The 286 PE ratio and the margin compression, those remain tangible, near-term risks that are being systematically ignored by the current market structure and sentiment.
So I think what we've really illuminated today is the complexity inherent in TSLA. It serves as the definitive example where narrative, sentiment, technological promise, and pure market microstructure all intersect to determine a valuation.
Precisely. The core synthesis is that the technical breakout above 385 was, without a doubt, the signal for this rapid surge. However, the actual delivery of the cybercab in 2026, the actual delivery of that optionality, is the ultimate destination that will prove which of our perspectives on this valuation is correct. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.